Dear students, welcome back to our fifth lecture of macroeconomics on the government and fiscal policy. In the previous two lectures, we considered a simple model of a macroeconomy called or known as the simple Keynesian model. Basically, the model consists of two sectors: households who make consumption or C and saving or S decisions, businesses which make investment or I decisions. We did see that equilibrium occurs in this simple model when income or aggregate output equal aggregate expenditure or AE. That is, when the equilibrium condition Y equal C plus I is satisfied or achieved using the first approach. Alternatively, when saving equal investment, that is, when the equilibrium condition S equal I is satisfied or achieved using the second approach. Here we want to add the government sector through government spending and taxes into our simple model to see how both government spending or G and taxes T will affect equilibrium output or the equilibrium level of income or aggregate output. The lecture covers the following points. 1. The government in the economy, where we discuss the influence or the impact of fiscal policies on the economy. Specifically, we will look at the influence of government spending and direct taxes on the economy, that is, on the level of equilibrium output or income. 2. Fiscal policy at work, that is, the multiplier effects, where we describe the effects of 3 fiscal policy multipliers. Typically, the fiscal multipliers or the multipliers related to fiscal policy are or include the government expenditure or government purchases multiplier, the tax multiplier, and the so-called the balanced budget multiplier. 3. The government or the federal budget, where we will look at the budget deficit and the budget surplus, and we will define each one of them. 4. The economy's influence or impact on the government budget, where we explain the impact or the influence of the economy on the federal government budget or the government budget. So we will look at the effect of the level of income on both government spending and government taxes, and therefore the government budget. 5. Deriving the fiscal policy multipliers. Specifically, we show that the government spending multiplier is equal to 1 divided by 1 minus the marginal propensity to consume, or the MPC. 6. The case in which tax revenues depend on income, where we explain why the multipliers falls when taxes depend on income. Generally speaking, in macroeconomics, the policy instruments, the tools or the instruments that the government make use of are fiscal policy and monetary policy. So let's distinguish fiscal policy from monetary policy. First, fiscal policy. This is the government spending and taxing policies. Policies relating to purchases made by the government and taxes collected or levied by the government. So the tool here, or with regard with fiscal policy, is government spending and taxes, while monetary policy refers to the actions or the behavior of the central bank, or as in the US, the Federal Reserve, concerning the nation's money supply, making changes in the supply of money in the economy by the central bank of the country. Also, we should know that taxes and government spending in many cases or often go up or down in response to changes in the economy. So simply this means that if government spending and taxes have an impact on aggregate output or income, aggregate output and income in turn have an impact on taxes and government spending. We want to define what is meant by discretionary fiscal policy. This means changes in taxes or spending that are the result of deliberate changes in government policy. Note that net taxes, or T, refer to taxes paid by firms and households to the government, minus transfer payments made by the government to households. Also note that disposable or after-tax income, denoted as Y sub D, or for short YD, is total income minus net taxes. Algebraically, this can be expressed as Y minus T. So, disposable income, or ID, or Y sub D, equal Y minus T. Income minus taxes. Disposable income equal total income minus net taxes, or YD equal Y minus T. Note here that the effect or the impact of taxes will appear through disposable income. The diagram we are seeing here shows adding net taxes, or T, and government purchases, G, to the circular flow of income. We see here that government spending, or G, is added to both investment by firms or businesses and consumption by households, and the sum of C, I, and G represents aggregate expenditure in this case. Here we show some algebraic relations. So we start with the first equation. Disposable income Y sub D, or YD for short, equals C plus S. Replacing Y minus T for YD in the first equation, we get Y minus T equals C plus S. This is our second equation. And moving minus T to the right hand side of the second equation, we reach at Y equals C plus S plus T. Finally, our final equation shows aggregate expenditure, which is the sum of consumption, investment, and government spending, or AE equals C plus I plus G. What is the budget deficit? A budget deficit refers to the difference between what a government spends and what it collects in taxes in a given period. Algebraically, the budget deficit equals G minus T, where G is greater than T. Or the budget deficit equals G minus T, where G is greater than T, or exceeds T. In the opposite case, which is called, or we call, a budget surplus, we will find that T is going to be greater than G, so the budget surplus is equal to G minus T, but where T exceeds G, or where T is greater than G. Here we see what happens when adding taxes to the consumption function. In this case, note that consumption and saving both depend on the level of disposable income YD and not the level of aggregate output or income, denoted as Y. To modify our aggregate consumption function to incorporate or to introduce disposable income, we write down the consumption equation in the form C equal A plus B times YD, or substituting for YD, we have C equal A plus B times Y minus T. The consumption function now, as a result of the presence of taxes, has consumption depending on disposable income Y sub D or YD, and not or instead of before tax income, denoted as Y. So be careful here in the case of the presence of taxes and government spending, the consumption and the saving will depend on YD and not Y. Planned investment. You should know that the government can affect investment behavior or decisions regarding investment made by businesses through its tax treatment of depreciation and other tax policies. Also, note that planned investment, as we saw before, depends on the interest rate. But from now on, we will assume that investment is a lump sum amount or an exogenous variable, that is a constant or fixed amount in our model to determine the equilibrium level of output or income. Using the first approach, the equilibrium level of output or equilibrium income occurs when income equal aggregate expenditure, or using algebra, when y equal AE. This is our equilibrium condition in this case. And we know that AE, or aggregate expenditure, equal C plus I plus G in this case. So equilibrium is achieved when y equal aggregate expenditure, which in this case equal to the sum of C plus I plus G, or simply the equilibrium condition in this case using the first approach is y, or can be written as y equals C plus I plus G. The table we have here gives us a numerical example of finding or determining the equilibrium level of income, assuming that investment or I equal 100, government purchases or government spending G equal 100, and taxes or T equal 100. As we can see from the table, column 1 gives output, or specifically before tax income, and as you can see, it starts at a level of 300, then 500, 700, going down to 1,500. Column 2 represents taxes, which is a constant, in this case equal 100. So at each level of income or before tax income, we see that the level of net taxes or taxes is constant at 100. Column 3 shows disposable income, and it is easy to find disposable income associated with each level of before tax income, or Y. So YD can be obtained by subtracting T from Y. For example, at an income level of 300, the disposable income is only 200. Why this is the case here? Because we subtract 100 from 300, so we get the level of disposable income, which is 200. If we move next to a value of y of 500, we will find that the level of disposable income is going to be 400. We get 400 by subtracting 100 from 500. We can continue obtaining or calculating disposable income at the remaining levels of before tax income in a similar way. So let's go very down to y equal 1,500. We will find that the disposable income at that level of before tax income is going to be 1,400, and we obtain that value for disposable income by subtracting T from 1,500. So we obtain a value of 1,400 for disposable income. Column 4 gives the different levels of consumption associated or corresponding to the different levels of both before tax income, which is Y, and disposable income, which is YD. So the numbers begins at 250, then 400, 550, 700, down to 1150. You will be given those values for consumption. In column 5, we have saving, and saving can be calculated by subtracting the value of consumption at each level of y or y sub d from yd and not y. So for example, the first value of saving, which is minus 50, can be obtained by subtracting the corresponding value of consumption, which is 250, from disposable income, which is 200, and not before tax income, which is 300. We can do the same thing to calculate the second value for saving, which is 0. This value of saving, which is 0, is calculated by subtracting consumption, which is 400, from disposable income, which is also 400. The next value for saving is 50, is calculated by subtracting the corresponding value of consumption, which is 550, from the corresponding value of disposable income, which is 600. So subtracting 550 from 600 gives 50. The next value is 100, can be calculated by subtracting the corresponding level of consumption, which is 700, from the value of disposable income, which is 800. So 800 minus 700 gives 100. We can continue calculating the remaining values of saving using the same procedure or in similar way. Column 6 gives the value of planned investment, and that value is assumed to be constant. So we see that the value of I is the same at the different levels of disposable income and before tax income, which is 100. Column 7 gives us the value of government purchases or government spending, which is also constant at 100. So we see the value of G is the same, which is 100 at the different levels of disposable income and before tax income. Column 8 gives us the value of planned aggregate expenditure or AE as the sum of consumption C and planned investment I, and finally government purchases or expenditure G. So to find the first value of aggregate expenditure or AE at a disposable income level of 200 and a before tax level of income 300, we add the corresponding values of C, which is 250, to the value investment, which is 100, to the value of government purchases, which is also 100. Those sum up to 450. So we obtain the first value for AE by adding 100 plus 100 plus 250. Those give us the first value of aggregate expenditure, which is 450. We can do the same thing and calculate the second value in column 8 by adding up the value of C, I, and G. So the value of consumption is 400 to be added to the value of investment, which is 100, to the value of G, which is also 100. So 400 plus 100 plus 100 gives 600. Can continue to do the same thing for the remaining values of aggregate expenditure. That is, we can obtain the remaining values for aggregate expenditure corresponding to the remaining values of YD and Y using the same method or the same way. Finally, note that equilibrium, according or using the first approach to determine equilibrium level of income, requires that C plus I plus G equal to Y, and we will find that this condition will be satisfied or will occur only at a level of B4 income of 900, because at a level of B4 income, which is Y 900, we will find that aggregate expenditure is also 900. So equilibrium will occur at a level of Y which is equal 900. If we use the second approach, the saving plus taxes equal to investment plus government spending approach, we will find that the sum of I and G, which is 200, will equal to the sum of S, which is 100, to saving, which is also 100 at the equilibrium level of output, which is Y. The graph we have here shows how we find equilibrium output or income graphically. It shows two things. First, the aggregate expenditure line, which is the sum of C, I, and G, and it takes, as you can see, the shape of an upward straight line shown in dark red, and also shows the 45-degree line representing the level of income or Y. And as you can see, equilibrium occurs when the aggregate expenditure line shown in dark red intersects the 45-degree line. And because G and I, or government spending and planned investment, are both fixed or constant at 100, we see that the aggregate expenditure function is the new consumption function displaced upward or shifted upward by the amount that is equal to the sum of I and G, which is 200. And finally, we see that equilibrium occurs at Y equals C plus I plus G equal 900. The saving investment approach to equilibrium. The equilibrium condition using this second approach says simply that equilibrium occurs when the sum of saving and taxes is equal to the sum of investment and government spending, or algebraically, the equilibrium according or based on the second approach occurs when S plus T equal I plus G. So that equation is just the equilibrium condition when we use the second approach. We can reach or conclude or derive this equilibrium condition, S plus T equal IG, as follows. We know that in equilibrium, Y equal AE, or income equal aggregate expenditure. We also know that aggregate expenditure, or AE, equal C plus I plus G. And we know that Y equal C plus S plus T. So at equilibrium and substituting for Y and also for A, we will find that C plus S plus T equals C plus I plus G. This is reduced to S plus T equal IG. Note that so far, or at this point, we are assuming that the government controls G and T, which simply means that both G and T are constant. In a different third meaning, that is, G and T both do not depend on the level of income. Neither one of G or T depends on Y. Now we will review three multipliers related to fiscal policy or taxes and government spending. The first is the government spending multiplier, the second is the tax multiplier, and the third is the balanced budget multiplier. The government spending multiplier. The government spending multiplier can be calculated by dividing 1 by the value of the marginal propensity to save, or 1 divided by MPS, and also by dividing 1 by 1 minus the marginal propensity to consume, or MPC. So we can write down the government spending multiplier equal to 1 divided by MPS, which is also equal to 1 divided by 1 minus MPC. The government spending multiplier can be defined as the ratio of the change in the equilibrium level of output or income to a change in government spending, or using algebra, the value of government spending multiplier is equal to delta Y divided by delta G. So this can be thought of as a second method of calculating the value of government spending multiplier. So either we use the first method, which is by dividing 1 by MPS, or 1 divided by 1 minus MPC, or by dividing delta Y by delta G. The table we have here shows finding equilibrium after a government spending increase of 50, or simply shows us how to determine or to find the equilibrium level of income as a result of an increase in the value of G by 50, or simply if delta G is equal to 50. Using the first approach, for example, we can find that the equilibrium, or the new equilibrium level of income, Y, is determined at a level of 1,100. Why? Because at that level of Y, of value of 1,100, we will find that the sum of C, I, and G will be equal to the value of Y. So at a level of before tax income, which is Y, 1,100, we find that the sum of consumption, which is 850, and investment, which is 100, and the new value or level of government spending, which is 150, that is 100 plus 50, is going to be exactly 1100, and this is why equilibrium occurs at that level of 1100. From the current graph, we can see that increasing government spending, or G, by 50 shifts the AE function, or a line, up by 50. Also, as Y rises in response, or as a result, additional consumption is generated, and finally, or overall, the equilibrium level of Y increases by 200 from 900 to 1100. The tax multiplier. The tax multiplier is the ratio of the change in the equilibrium level of output to a change in taxes, or simply the tax multiplier equal delta Y divided by delta T multiplied by -1. To calculate the change in the level of before tax output or income when we have a change in government spending, or G, we use the equation delta Y equal initial increase in aggregate expenditure multiplied by 1 divided by MPS, or the marginal propensity to save. So, for example, applying or using this equation, we can find the change in Y when the change in G is 50. So we'll multiply 50 by 1 divided by the value of MPS, which is 0.25 in the previous example. To calculate the change in Y when we have a change in the level of taxes, we use the equation delta Y equal minus delta T times MPC times 1 divided by MPS, or by multiplying minus delta T by MPC divided by MPS. And we can see that the multiplier in this case, which is the tax multiplier, equal to minus MPC divided by MPS. The balanced budget multiplier. This is the ratio of the change in equilibrium level of output to a change in government spending, where the change in government spending is balanced by or is equal to a change in taxes so as not to create any deficit. In this case, the balanced budget multiplier is equal to 1, or unity. The change in Y resulting from the change in G and the equal change in T is exactly the same size as the initial change in G or T. The balanced budget multiplier is equal to unity, or 1. The table we have here shows us how to find the equilibrium level of output after a balanced budget increase in G and T of 200 each. So this simply means that delta G equal delta T equal 200. G increases by 200, and also taxes increases by 200. In this case, and by applying the formula of the change in Y equal 1 times the change in G, we will see that the change in Y, or delta Y, is equal to the change in either G or T, which is 200 in this case. So note that both G and T have increased from 100 in the table to 300. The table we have here summarizes the three multipliers So let's begin with the government spending multiplier. We see that increase or decrease in the level of government purchases, delta G. The value of the multiplier is calculated by dividing 1 by the marginal propensity to save, or 1 divided by 1 MPS, and we can find the final impact on equilibrium of an increase or a change in G by multiplying the initial change or increase in G, which is delta G, by the value of the multiplier, which is 1 divided by MPS. Next, we move to the tax multiplier. We see that an increase or decrease in the level of net taxes, or taxes just for short, delta T. The value of the multiplier, the tax multiplier, is calculated by multiplying minus by MPC divided by MPS, and we can find the change in Y by multiplying delta T by minus times MPC divided by MPS. Finally, the balanced budget multiplier, the stimulus balanced budget increase or decrease, simultaneous balanced budget increase or decrease in the levels of government purchases and net taxes when delta G equal delta T. The value of the multiplier, the balanced budget multiplier, is unity or equal to 1, and the resulting change in Y or delta Y will equal delta G. Note that although we have added government, the story told about the multiplier is still incomplete, not complete, and oversimplified. Also, we have been treating or assuming that taxes or net taxes T as a lump sum of fixed amount, whereas in practice taxes depend on income. Finally, we will show that the size of the multiplier is reduced when we make the more realistic assumption in which we will find that taxes depend on income. Fiscal policy is the manipulation or directing of items in the federal budget, so the federal budget or the government budget is relevant to our study of macroeconomics. So what is the federal or government budget? Is the budget of the central or federal government. The federal or the central budget is the product of a complex interplay or interaction of social, political, and economic forces. The government debt or the federal debt is the total amount owed by the central or the federal government. Privately held federal or government debt, the privately held, non-government owned debt of the, let's say, the Egyptian government or the US government. The economy's influence on the government budget. This can be shown using the following terms. So we have automatic stabilizers and destabilizers. Automatic stabilizers refers to revenue and expenditure items in the federal budget that automatically change with the state of the economy in such a way as to stabilize GDP. Automatic destabilizers are revenue and expenditure items in the government budget that automatically change with the state of the economy in such a way as to destabilize GDP. Fiscal drag. This is the negative effect or impact on the economy that occurs when average tax rates increase because taxpayers have moved into higher income brackets or branches during an expansion. The full employment budget. Full employment budget, what the federal budget would be if the economy were producing at the full employment level of output. So full employment budget refers to what the central or the government or federal budget would be if the economy were producing at the full employment level of output. Structural deficit. This is the deficit that remains at full employment. So simply means that even when the economy reaches full employment, is still with a deficit. Cyclical deficit. This is the deficit that occurs because of a downturn in the business cycle.